So this paper is level 4, applied management accounting. And of course, like this is one of the very important paper we have for level 4. With the QS16, this paper had a two combinations. So we had management accounting, budgeting, and we had decision making and control. But with the QA 2022, this two paper is the combination is one paper. So now it's not two paper, it's only one paper. So for that reason, the AAT full level 4 syllabus is a little bit less than AQS 16. So we have only 3 mandatory paper, and this is one of them. So let's have a look at the content we're going to cover. So you can see here we have 14 chapters. So mainly to cover the costing and the decision making. So chapter 1 to 14 is all about the budget and preparation of the cash flow statement, short-term decision making, long-term decision making, and divisional performance. They also added some ratio analysis. Before it wasn't with the QS16 syllabus, but now we need to look at some ratio analysis as well. The paper description is quite simple. This is the only exam we have 3 hours for level 4. Any other exam we have 2 hours, but this is the only exam we have 3 hours. Let's quickly look at how many questions you're going to see in the exam. So it will be 3 hours exam. We have to score 70%, and we're going to look at 1, 2, 3, 4, 5, 6, 7, 8 questions in the exam. So it will be a total 8 questions in the exam, and it will be the combination almost every single chapters we're going to cover. So let's have a look. The first chapter we have here, that is kind of similar that we have done on our level 3, management accounting for level 3, but it will be a little bit advanced version. So let's have a look what we have here. Costing technique, that's our first chapter for this paper. Costing technique, we can see here, it says budgetary responsibility, and of course, like all these things that we're going to look at from this chapter is very important, because we're going to look at every single question, every single activities, and in the exam the marks will be from everywhere, so we cannot just avoid anything. We need to make sure we understand every single topic we have. So here it says, after reading this chapter, the student able to understand the direct cost, indirect cost, fixed and the variable cost, semi-variable cost, step cost, capital, and revenue. So this is almost a thing that you always see on our level 3 paper. We have seen this thing. So the level 4 we just copying it once again, but as I said, like this will be a little bit like different than level 3. So let's look at the chapter overview and discuss a little bit here. On the chapter overview, we have cost behavior. Now, cost behavior represents how the costs behave. We have a different sort of cost. So fixed cost, we already know the fixed cost will remain fixed regardless of the activity level. So how much unit or how many unit you're going to produce regardless, but the fixed costs remain fixed. For example, the rent. Normally, rent is the common example, or the salary for the fixed cost. So even though we open our office or not, or if we make a production or not, the fixed cost for the rent we have to pay anyway. So let's have a look this graph. So it says, you can see this rate. Normally on the left hand side, this shows the value, and on the bottom it shows the unit. So for example, if the rent is £5,000, regardless I make 100 unit, or if I make 200 unit, or if I make 300 unit, my rent remains same. So for that reason, fixed cost is always fixed. But one thing we have to remember, the fixed cost is fixed in total. So the fixed cost is fixed in total. But per unit, it will change. But per unit, it will change. So the fixed cost remain fixed in total, but per unit, it will be changed. So that means if we make more unit, the fixed cost per unit will be reduced. So this is the first thing we have to understand. For example, if my rent is £2,000, or let's say my rent is £2,000, the rent. And if I make 1,000 unit, then rent per production will be £2. And if I make 2,000 unit, so rent per unit will be £1. That means if I make more unit, the fixed cost per unit will be reduced. The next one we have here, that is step cost. Step cost is a very much common, and of course, like step cost, sometimes we called it like where the cost fluctuate after a certain level. So the cost is fixed up to a certain level, and after that it jump to the same amount for the next level. So you can see here the graph, it says it is fixed up to here, and after that is going up, again is increasing, this going up is increasing. Normal example we can say for the fixed step cost, for example, the supervision cost. Supervision cost. So the supervision cost means, for example, under one supervisor, maybe he can supervise 100 employees. So one supervisor can supervise 100 employees. Now, if it is more than 100 employees, then the supervisor need another session, or maybe we need another supervisor. For example, for 1 hour for 100 employee supervision, maybe a supervisor charge £100. So for up to 100 employee, one supervisor for 1 hour he charge £100. Even for 101 people, so for one person, the supervisor need to spend 1 hour, so he will charge another £100. That means up to 100 people, the cost is fixed 100, and even for one unit, the cost will jump to exactly the same way like another 100. For example, when the teacher teach in a class, maybe in one class 20 people can sit, so up to 20 people the cost is same for the whole day. Even if it's 21 people, for one person the teachers need to set another session, so that will make him cost another same amount. That's the example of the step cost. The next one we have here, variable cost. Variable cost is very straightforward. So this cost is completely variable with the activity level. That means if I make any unit, there will be a cost. If I don't make any unit, there will be no cost. For example, this is start from the 0. If I make 1 unit, for example, my cost is 1. If I make 2 unit, my cost is 2. And if I make 3 unit, my cost is 3. If I make 4 unit, the cost is 4. So the level of activity is increasing. At the same time, the cost is also increasing. This is the example of variable cost. The next one we have semi-variable cost. Semi-variable cost is all about when there is a mixture of the variable cost and there is a mixing of the fixed cost. When these two costs are together, we call it semi-variable cost. That means up to a certain level, the cost is fixed, and after that it is variable. For example, if you're looking at the internet or maybe the BT mobile phone, so £15 is the line rental. So £15 is the rental cost. So this one we have to pay anyway, either we use the phone or not. But if we use it, then it will be plus per minute or per call, it will be different. So up to 15 is the fixed cost, and then plus a variable, depends how many calls we make. So this is a very common example for the variable, semi-variable cost or the mixed cost. So mixed cost represent the variable cost and the fixed cost together. Now the next thing we have here, if there is a mixed cost or total cost, and if the question don't tell us like how much is the variable and how much is the fixed, how are we going to find it out? And we're going to use the high-low method. This is also a very common method that we have done on our level 3. So in high-low method, we're looking at the higher amount of the unit and the higher amount of the cost, and the lower amount of the unit and the lower amount of the cost. Then we find the difference to find it out how much is the variable cost per unit. And after that, we separate the cost. For example, if the mixed cost is total 10,000, that means we need to find it out how much is the fixed cost and how much is the variable cost. By using the high-low method, we separate the total cost in the form of either fixed cost, in the form of either variable cost. So this is the very easy method that we have done on our level 3 as well. So let's move on to the next page. The next page we have here is called cost classification. The cost classification will tell us a little bit detail about the cost center, profit center, investment center. So let's start with that cost classification. The first one, we have a cost centers. Now, cost centers are the center who incur only the cost. So location or function that is responsible only for the cost. So they are not responsible for any other thing. They're not responsible for the revenue. They're not responsible for the profit. They're only responsible for the cost. For example, let's say one car company, BMW, and this car have a different department. For example, one department, they make the engine, another department, they make the seat, another department, they make the glasses. So every department is a cost center because they don't make any profit. And when the whole car is ready, they assemble and they sell it. So basically the selling department, they might make a profit or they generate some revenue. So the cost center is the center, they only generate cost. For example, the canteen, for example, the store, they don't have any revenue at all, or maybe the maintenance. Then we have a profit center. Profit center dealing with two things. One is the cost and one is the revenue. So the profit center, they have to looking at how much is the cost and how much is the revenue, because to find it out the profit, we need to know how much is my sales and how much is the cost. The difference is generated is the profit. The next one, we have investment center. The investment center is responsible for the cost, revenue, and the capital. For example, if we look at the example of Tesco, and Tesco every year they try to open a new branch. So this is the job for investment center people. They decide where and when they want to invest for the new branch. So this is not the job for cost center or not for the profit center. This is the investment center people who is responsible for making a new investment. On the other side, we have a classification by the function. Normally, the production center have any sort of manufacturing industry, they have a two type of cost. For example, if I like to make something, if I like to produce something, there will be production cost and there will be some non-production cost. Sometimes the non-production cost, we call it indirect cost, and sometimes we call it overhead. Now, the production cost relevant to the product. For example, if I make a pen, and in the pen, maybe we're going to see some plastic, maybe we're going to see some ink. This is all the direct cost. And we have some indirect cost as well. For example, heat and lighting. For example, the salary, for financial cost, non-administrative cost. There's a lot of costs could be involved with that. But some cost that is directly attributable, or we can see, like for example, how much plastic we have used to make the pen. For example, 10 gram, or how much ink we have used inside of the pen, maybe 5 gram. So this sort of cost is visible or traceable, and that's why we call it direct cost. Also, the labor cost is also part of the direct cost. So the labor cost also is a part of the direct cost. Labor cost represent how much we spend for the labor, the direct labor or the material. So this is part of the direct cost as well. On the other hand, we have indirect cost. Indirect cost represent the cost we cannot see or we cannot touch, or maybe it is overhead. For example, the heat and light to make the pen, or maybe the rent. So this sort of cost come as the overhead. It could be a variable, it could be fixed. Now, indirect cost is says incurred as a result of making a product, but not directly traceable or attributable. On the right-hand side, we have a classification by nature. We have a material, that's the raw material that we use to make the product. That's the labor. The labor can be skilled labor or it could be unskilled labor. So labor is also part of the direct cost. Remember that when you calculate the labor cost, it is possible sometimes you can see in the question overtime. Now the overtime is a direct or indirect cost, is depends on the question. If the question tell you it is for a specific product, so for example, based on the customized order or based on the customer order, we are building something customized, that case the overtime will be the direct cost. But if it is general product, for example, we're making for everyone or making in a batch, in this case the overhead will be indirect cost. That means it will be the overhead, it's not a direct cost. Then overhead, all the cost that is not part of the direct cost, we called it overhead. Then we have a classification by type. This is also very common for us, capital expenditure and the revenue expenditure. Capital expenditure represent if we buy an asset. If we buy an asset and we assume this asset we're going to use at least 1 year or more. At least 1 year or more, then we called it capital expenditure. Also, if we make an improvement, and because of this improvement, the efficiency of the asset is increased. For example, if you have a computer and we have right now 2 GB RAM, and if we add 4 GB RAM, that means the speed of the computer will increase, and that is improvement. That will be the capital expenditure. If we have a single glass window in the door, if we use the double glass, then it will be also capital expenditure because it improves the efficiency of the glass. But if we have something, the cost that is a day-to-day expenditure, for example, paying the wages and salary, paying the rent, paying the bill, or buying the raw material, that is mainly the revenue expenditure. So day-to-day expense. Day-to-day expense. And sometimes we can categorize it as a working capital. So this sort of cost comes under the revenue expenditure. The next thing we have here, how to allocate this cost. Now here we're going to looking at the costing method. So we have a absorption costing and we have a marginal costing. These two are very common method to calculate the unit cost. So for example, if we're looking at the absorption costing, and if we're looking at the marginal costing, the basic difference for the absorption costing and the marginal costing is under the absorption costing, we calculate the OAR, that is overhead absorption rate. Here, we take the fixed cost as a part of the product. So fixed cost will be treated as a product cost. But on the other hand, on the marginal costing, the fixed cost we treat as a period cost. That means under the absorption costing, the fixed cost will be inside of the product, but under the marginal costing, the fixed cost will be the outside of the product. So if we want to see a little bit in detail, for example, if we want to make a format, for example, if we say absorption costing and if we say marginal costing. So first we do the sales. We look at how much is the sales. There is no problem for the sales. And after that, we minus the direct cost, or that is variable cost. Let's say less the variable cost. Now, if we minus the variable cost from the absorption costing and the marginal costing. So under the absorption costing, we minus the variable cost, also the fixed cost, to find it out how much is the profit. But under the marginal costing, we only minus the variable cost. And once we minus the variable cost, the amount we have here, we called it contribution. And from the contribution, we minus the fixed cost later to find it out, my profit. That means under the absorption costing, we include the fixed cost as a part of the product, but under the marginal costing, we never add the fixed cost as a part of the product. All right, so this is more or less the explanation. Now we can go inside of the chapter and we can actually see some question, and then we'll understand it more. Even though the first chapter will be very basic, but we'll quickly go through so that we understand it. Let's looking at our first activity. So the first activity we have here, that is cost behavior. It says, a manufacturer of a single product has supplied the budget information for the next quarter end. Okay. And it says material per unit, that is 1.5 kilo at 4.5 per kg. So we need 1.5 kilo. That's okay. It's not a problem. But we have to use 1.5 kilo, 4.5 per kilo. Okay. Rent per quarter, for 1 quarter it is 6,500. Supervisor cost 2,000 for every 2,500 unit produced. So we need to find it out what type of cost it is. And electricity, 1250 per quarter plus 130 per unit. On the requirement is asking, calculate the budgeted quarterly cost of production for the following activity level to the nearest pound and classify each cost. Okay, the first one is the direct material. Direct material is always variable cost. If I make more material, if I make more unit, I need more material. If I make less unit, I need less material. Simple as this. So for 2000 unit, we can see here. So for 2000 unit and 9000 unit, we need to do both. So for 2000 unit, per unit, we need 1.5 kilo. And of course, like per kilo is 4.5. And that will give us 13,500. So 13,500 will be the direct material cost. For the 9,000, same way, for 9,000 unit, per unit, we need 1.5. And per kilo is 4.5. And that will give us 60,750. 60,750. And remember that the direct material is always a variable cost because it changes with the activity level. That means if I make more unit, then I have more cost. If I make less unit, I have a less cost. So this is a variable cost. The next one is a rent. Rent is always normally fixed cost because regardless I make any unit or not, the rent remains same. So we have 6,500 for the whole quarter. So either I make 2,000 unit is 6,500, but either I make 9,000 unit is still 6,500. And that's a fixed cost. Supervisor cost, 2,000 for every 2,500 units. So up to 2,500 unit, the cost is fixed, that is 2,000 pounds. Okay, so we need to see how many units we are making. So for the first one, obviously we can see we are making 2,000 unit. So up to 2,500 unit, the cost is fixed, 2,000 pounds. So it says 2,000 pounds is fine. But when you're making the 9,000 unit, we have to break it down. So it's a 9,000 divided by 2,500. Because for every 2,500, the cost is 2,000. So 9,000 divided by 2,500. That gives me 3.6. 3.6. That means I need a full 3 and 0.6. 0.6 is still I need the full cost because obviously like for every single 2,500, we need to spend 2,000 pounds. So I said we have 4 times 2,000 is 8,000. Or you can say 2,500 unit, the cost is 2,000. Then the next 2,500 is again 2,000. Next 2,500, again 2,000. And finally, we have few more units left. So we have 7,500. So 9,000 minus 7,500, that's last 1,500. Still, we need 2,000 because up to 2,500 is 2,000. So if we add it is 8,000. So that's my 8,000 for 9,000 unit. And this is my step cost. And finally, you have electricity. It's a 1,250 per quarter. So it is fixed up to 1,250 per quarter plus 130 per unit. So it's look like it is a semi-variable cost because some costs look like fixed and some costs look like variable. So the fixed here is a 12.50 and after that is a variable per unit. So let's have a look how many units, 2,000 units. So it's a 1,250 plus 2,000 unit and per unit is 1.30. So we say 2,000 unit times 1.3 plus 1,250 and that gives me 3850. So 3850. Same wise this one 1,250 is the fixed plus for 9,000 unit per unit is 130. and that will give us 12,950. And that is my semi-variable cost. And that's it. So this is how we're going to complete this question. And of course, like you can see, it's not very difficult because this sort of thing we have done on our level 3 as well. And of course, this is just the starting. So it's not very difficult. Let's move to the next one. The next one we have here, the high-low method. The high-low method is a very simple, we have done before as well. So we don't have to look at the example. We can straight away go to the question to see how to do the high-low method because it's quite simple. To do the high-low method, we need the high unit and the high cost and the low unit and the low cost. So you can see here, we have the question. It says, you have been supplied with the following information about the factory overhead. So you have a 15,000 unit, the cost is 250,000. And when we make 19,000 unit, the cost is 290,000. The fixed portion of the overhead increased by 5,000 when more than 20,000 units are produced. So the fixed portion of the overhead, so fixed cost increase by 5,000. That means we need to add 5,000. How much is the fixed cost? First, we have to find it out. Then we have to increase by 5,000 if we make more than 20,000 units. Due to the organization of obtaining bulk discount from the supplier, variable cost reduced by £1.50 per unit if more than 22,500 units are produced. That means if we make more than 22,500 units, the variable cost will be reduced by 1.50 because of the bulk discount. Because if we buy more, then our supplier give us some more discount. All right. Okay, so let's have a look. Calculate the total fixed and the variable cost. So let's try to do it. The first thing we're going to look at here, we find out the difference between the higher cost and the lower cost. So let's find it out. So we have a total cost that we can see high is 19,000. So we make 19,000 and the cost is 290,000. Then we have a 15,000 lower cost and the cost is 250,000. The difference we have here, 4,000 a unit, and with the cost, the difference is 40,000. Then this unit we need to put under the divide. So 40,000 divided by 4,000, and that will give us 10 per unit. This is my variable cost. So this is the first step. First step is to find the difference between the higher and lower, the cost and the unit, and divide the cost with the unit, and that will give us the variable cost per unit. So once you have the variable cost, then you can find the fixed cost. So let's try to find it out. How much is the fixed cost? We can take any of this. So we can take that 19,000. So let's take the 19,000. So 19,000 total cost was 290. Now, if I can take out all the variable cost, the remaining will be the fixed cost. So 19,000 unit, the variable cost is 10. So if we multiply by 10, this 190 will be my variable cost. And if I take it out, the difference is 100,000, and that is my fixed cost. So from the total cost, we take out all the variable cost, and the difference we have the fixed cost. Now we can find it out. Our question, what they're saying. They're saying what happened if we make 17,000 unit? What happened if we make 25,000 unit? Now, if we make 17,000 unit, that doesn't make any difference because the fixed cost will be only increased if we make more than 20,000 unit, and the variable cost will be only decreased if I make more than 22,500 units. So 17,000 will not give us any advantage. For the 17,000, fixed cost remain fixed, that is 100,000. And the variable cost is very simple. So 17,000 times 10 per unit, that will be 170. That we have calculated before, variable cost per unit. But for the 25,000, we need to do a little bit calculation because our fixed cost will be increased by 5,000. So before it was 100,000, now it will be 105. Because I'm making more than 20,000 units, so fixed cost will be increased by 5,000. So this is the first thing. But at the same time, my variable cost will be also decreased by 1.5 because I'm making more than 22,500. So let's have a look. So currently my variable cost is 10. So it will be reduced by 1.5. So 10 minus 1.5. And that will give us 10 minus 1.5. That gives me 8.5. 8.5. And if I make 25,000 unit, that will give me multiply by 25,000 unit. That will be 212,500. So 212,500. So my variable cost will be reduced by 1.5 if I make more than 22,500 units. So this sort of question can be come in the exam because they'll give you a little bit of adjustment and you need to know how to do it. But it's not very difficult. You can see still very simple calculation. All right, let's move on to the next one. And the next one we have here, the difference between the capital and revenue expenditure that we have discussed. So that is nothing, I think we can find this difficulties quite simple. All right, so the next one we have a direct indirect cost. The prime cost, obviously we know that. The prime cost means the total of the direct cost. All the direct costs together, we called it prime cost. Then we have the next one, that is indirect production costs. Indirect costs are the costs which are incurred in the course of making product, service, but which cannot be identified as a particular cost. We have discussed that as well. So let's move on. Then we have some responsibility centers. We have a cost center. The cost center is an area of the business, for example, a department such as the factory or canteen, for which costs are incurred. So if we have a canteen in a factory, the canteen just have a cost. They don't have income because they provide the meal to the staff and they don't charge anything. So of course they don't have an income, only the cost. So this sort of thing is a cost center. We can have a production cost center. We have a service cost center. Production cost center, this cost center directly involved with production, provision of the cost unit. Service cost center, this cost center are not involved in the production or provision, but are need to support or service the production cost center. For example, once we make a product, sometimes we give a guarantee or warranty. So obviously, like if we give a guarantee, if we give a warranty, then some people need to provide the maintenance service. So when you give the maintenance services, that's basically the service cost center because they don't have an income, but they have some cost. All right, the next one we have a classification cost center. So let's have a look. Activity 3. So we have few cost center and we need to identify which one is what. Is it a production cost center or is it a service cost center? So let's read the question first. So we can see here it says the canteen. Canteen is always service cost center. Service cost center because the canteen have no income. Is store also service cost center? For example, if we have a BMW car, the store sell the car, but they don't have an income. But the store have a rent, the store employee have a wages, but they don't have an income. Then stitching, this is a production. So basically, if you have a clothing, if you make the stitching, so obviously you're making something. It's a production. Maintenance is a service. Packing is a production. Finishing is also production. So where the work is involved to make a product or complete the product, that's a production center. And normally the service center is after the production. So once the product is ready, then when you give it to the customer, then you have to provide some after sale service. This is mainly considered as a service cost center. All right, the next one we have here, method of costing. So this one we have discussed. We have a absorption costing method, and we have a marginal costing method, and we have activity costing method. Activity costing method is basically, it is more accurate from the overhead allocation point of view. Under the activity-based costing, the overhead allocated more accurately by using the cost driver. But it's not very common method. Not every organization have this time to use the ABC or activity-based costing, because it's time consuming, and you have to have a cost driver, you have to have a cost pool to identify the correct cost driver so that you can allocate the right cost to the right cost center, but it's time consuming. For that reason, most of the company, they use the absorption costing and they use the marginal costing. The main difference between the absorption costing and the marginal costing is the fixed cost, as we discussed before. Under the absorption costing, fixed cost included inside of the product, but under the marginal costing, fixed costs stay outside of the product. That's the main difference. Normally, whichever method you follow, normally the profit remains same, unless the company have a closing inventory. For example, if the organization don't have any closing inventory, then any method you choose, the profit will be same. We're going to look at later on. All right, so you have absorption costing here. Absorption costing is a very common. We know already how to do it. Here we're looking at the OAR, that is overhead absorption rate, is an estimated overhead of fixed overhead used to produce one cost unit. For example, when we have a one cost unit, we have a direct material and we have a direct labor and we have an overhead absorption rate. So the way we calculate the OAR, that is total production overhead divided by total activity level. Now, the activity level could be the machine hour, could be the labor hour, or could be the unit. For example, if my total production overhead is 3,000 pounds, and for example, if my total activity level, that is the unit, let's say 300 unit, or 300 machine hour, or 300 labor hour, then it will be 10. The overhead absorption rate will be 10. So per unit, my overhead will be 10. But remember, it is the budgeted one. That's the budgeted. That's the budgeted. That's the estimate. And for that reason, every time when we prepare the profit and loss statement, then on the profit statement, you always look at under or over absorption. So when you prepare under the absorption costing, we always looking at, is it under absorb or over absorb? Why? Because under the absorption costing method, I make estimate. For example, I make estimate my overhead will be 10,000 pounds. But actually the overhead is 9,000 pounds. That means I make a overestimation. That means is over absorbed. Over absorbed. So it could be opposite. Maybe I estimated 9, but actual overhead is 10. That means I make under absorption. So we always need to check, did I make the over absorption or did I make the under absorption? So we need to compare our budget with the actual. All right, so the next one we have here, we have one example. So let's do one question to understand it better way. Okay, we have activity 4 in Galaxy. The Galaxy production department produced 2 types of unit, okay? The overhead for the department are as follows. So we have a 2 type of overhead: supervisor salaries, that's the overhead; machine running cost, that's the overhead; and machine maintenance overhead and depreciation of the machine. So the total overhead, we have 38,000, and 2 types of unit they make. Okay. Then we have here, the next one here is says, the department produced 2,000 unit. The department produced 2,000 unit of Pluto, and production uses 5,000 machine hours. So they use 5,000 machine hour. The actual overhead incurred is 40,000. So here we need to find it out. Is it under absorb or over absorb? Actual machine hour use 4,000 hour. So first we need to find it out. How much is the OAR, that is overhead absorption rate? So let's find it out, the overhead absorption rate. So my total overhead is 38,000. So 38,000 is the total overhead. And we need to divide with the activity level. Now here, the activity level is machine hour. They say production use 5,000 machine hour. So we need to divide with the 5,000. So my OAR, overhead absorption rate or recovery rate, is 7.60 per machine hour. Now we can see here, actually we have used 4,000 hours. So 4,000 hours should cost 4,000 times 7.60. So let's do that. 4,000 times 7.60. That should be 30,400. But the actual is 40,000. Actual is 40,000. That means I make a under absorption because actual is more. Actual is more than my plan or my budget. So this is, I make an underestimation. Remember that always we check ourselves. Did we make the under or did we make the over? So I make the under absorption. So find the difference, and the under absorption will be 9,600. So it will be overhead recovery rate will be 7.60 per machine hour, and overhead are under absorbed by 9,600. So our estimation was low because actual is more. All right, let's move to the next one. The next one we have here marginal costing. Marginal costing is quite simple. All you have to do, you have to find how much is the variable cost to find the contribution and minus the fixed cost to find the profit. Okay, let's do one question for the marginal and the absorption. So we have here absorption versus marginal costing. So let's try to do it. A business is expected to produce 5,000 units of a single product in the next month, okay, with the following cost being incurred. So you have a direct material, direct labor, variable overhead, and fixed overhead. So we have all the cost. Complete the following table to show the cost per unit under the absorption costing and the marginal costing. So it's quite simple. So you have absorption costing and you have a marginal costing, okay. So we can see here how much is the direct labor, how much is the direct material. So the first one, direct material, it will be same for both under absorption or under marginal, no problem. Then direct labor, again, same. All the variable cost will be same for both. So it's 15,000. Then we have 15,000. Then you have a variable overhead, again, same variable overhead, 23,000 and 23,000. Up to here, we don't have any problem. So we need to see after that you have a fixed overhead. Now the fixed overhead we need to only include under the absorption costing. So fixed overhead only under the absorption, not on the marginal. Then we make a total. So it will give me 75,000 under the absorption. $75,000 under the absorption, and for the marginal we will have 50,000. Now I need to divide. If we divide by 5,000 unit, so divide by 5,000, so 75,000 divided by 5, it is 15 per unit. And 50,000 divided by 5 is 10 per unit. And that's it. So only the difference here is under the absorption costing, we included the fixed cost. Under the marginal costing, we didn't include the fixed cost. All right, the next one we're going to look at a little bit in detail, the profit statement. As we said, how to calculate the contribution, you already know that, sales revenue and minus all the variable costs. So the contribution means sales minus the variable cost. All right, so let's do one detailed question. We have here some example, but we can actually do one question to see. Okay. Activity 6. Let's make this profit statement. So the opening inventory, we have for month 1, 0. For month 2 is also 0. Don't have anything. Selling price 100 and 110. Production unit, on month 1 we make 15,000 unit, and month 2 we make 15 as well. Sales, on month 1 we sell 11,000 unit, and month 2 12,000. Here we have to stop a little bit. We have to be a little bit careful here. We make 15,000 unit, but we actually sold 11. So that means 15,000 we make and we sold 11,000 unit. That means from here I have 4,000 unit. So whatever is the month 1 closing will be the opening for month number 2. So that's month 1 and that is month 2. So we will start the opening inventory with 4,000 and we make another 12,000 or another 15,000 on month number 2. So another 15 I make. I sold only 12. So that means that will give me 4 plus 15 is 19,000 minus I sold 12,000. That means it will give me the closing inventory 7,000 here. So this calculation is very important because otherwise you'll be confused how the profit is different. So you need to understand that. The next one is says direct material per unit 1010, labor 8 and 8, overhead we have variable 180, 180, fixed production cost 300,000, 300,000. Fixed production overhead for both budget 270 and budgeted production unit is 18,000. The reason we need it to find it out how much is the fixed cost per unit. Okay, so let's have a look. Let's start with our sales. The sales we have 100 month 1, so under the absorption costing and marginal costing will do both. So sales we have 11,000 unit. So 11,000 multiply 100 per unit, that will give me 1100,000. So it takes sales 1100,000 and that's for both absorption and marginal is same. Remember that sales remain same. Both method month 1. We are doing now month 1. Remember that. Then opening inventory. Month 1 we don't have any opening inventory. So it will be 0 for both absorption and marginal. Production cost, how many unit we produce? We produce 15,000 unit on month 1. So 15,000 unit we make the production. And we need to see how much is the production cost total. So how we find it out that? So we have a direct material 10. So direct material 10 Then we have a 8 direct labor, and we have a variable overhead. They said variable overhead is 180,000 for how many unit? For 15,000 unit. So we have here variable overhead 180,000 divided by 15. So that will give me 12 variable overhead. So that gave me total 30. That's my marginal cost. Remember that all the variable cost together, we called it marginal cost. So that's my total marginal cost. Now I want to find it out how much is the fixed cost per unit. The fixed cost is total. They are saying 270 for how many unit? 18,000 unit. So we said 270 divided by 18,000. So remember that do not take the fixed production cost, always take the fixed overhead. And that will give me 15. So my fixed overhead is 15. And that will give me 45. The reason I make it separate, one for 30, because when I do the marginal costing, I will need the 30. And when I'll do the absorption costing, I need the full cost. So I need 45. Okay, so we have it now. So 15,000 unit, and the cost is 45 under the absorption costing, 45 per unit. So 15,000 we make times 45, and that gives me 675,000 for month 1 under the absorption. And for the marginal, we do same thing, but we multiply with 30. Under the marginal, we only take the variable, so multiply by 30. 15,000 multiply 30. 450,000. 450,000. And then the closing inventory. Closing inventory, we make 15 and we sold 11. We calculated before here. 4,000 we have the closing inventory. And 4,000 under the absorption, we multiply by 45. 4,000 multiply 45. And that gives me 180,000. So closing inventory always minus, remember that, 180,000. And under the absorption, we're going to multiply 4,000 multiplied by 30. That will give us 120,000. And that will give us our cost of sales. So let's calculate the cost of sales. Cost of sales for the month 1 under the absorption costing, we have 495,000 minus that. And for under the marginal, we have 330,000. So the difference between the production cost minus closing inventory, these two. All right, now we can find our under or over absorption is very important. It's only for the absorption costing. Remember that under or over absorbed. So under and over absorbed, the way we calculate, as I said before, we need to see how much we make the estimated and how much actually was the cost. So let's have a look. So we have here, we said for 15,000 unit, for 15,000 unit, it will be 15, the fixed cost, only the fixed cost, remember that, multiply by 15, and that will be 225. So according to our plan, it should be 225,000, the overhead absorption. But actually, we can see it is 300,000. So this is more than my plan. So actual is 300,000. So I make under absorption. So my estimation was low. How much low? 75,000. That means I consider less expense. I thought my production overhead expense will be 225 based on my plan, but actual production cost for the overhead is 300,000. So that means it is more than my plan. So expense will go up. If the expense goes up, remember that profit will go down. So 75,000, the expense need to go up. As the cost of sales is a minus, that's why I'm taking as a minus. All right, so this will be for both month, because month 1 and month 2 both we have a 300,000, but I make estimation only for 225, so 75,000. And that's it. Now we can find the profit. So we have now cost of sales. We added these two and minus from the sales, and that will give us how much is the profit. So that is 530 for month 1. And for the marginal, we need to minus our fixed cost. So the fixed cost we have here, this is actually not here, so we can take it out. It should be month number 2. Remember that overhead absorption is only for the absorption, under or over absorb only for the absorption. Okay, 300,000 is the fixed for the marginal cost. Marginal cost don't have to do anything else. So marginal cost, we need to minus the 300,000. How much is the overhead? In marginal cost, we don't have to find the under or over absorb. Okay, so under the marginal cost, we can see our profit is 470. So under the absorption costing, the profit is 530,000. And under the marginal costing, the profit is 470. It is always happen. Under the marginal costing, our profit will be always higher if we have a closing inventory. Remember that, because when we calculate the unit cost, we do not calculate the fixed cost under the marginal cost. For that reason, when you have a closing inventory, for example, if you have a closing inventory under the absorption and under the marginal, so let's say we have 10 unit, both 10 unit, 10 unit. Under the absorption, it will be multiplied, for example, by 20. Under the marginal, it will be multiplied by 15. Why? Because the marginal costing do not include the fixed cost. For that reason, here it will be, for example, 200, and here it will be 150. That's closing inventory. And if we minus the more closing inventory, my cost become lower. And if the cost become lower, then the profit goes higher. That's the main reason behind, the logic behind the absorption costing give you more profit than marginal, because of the fixed cost on the closing inventory. All right, for the month 2, same thing. We have 110 selling price. We sell 12,000. So 12,000 multiply by 110. So it will be 1,320. Same for the marginal, 1,320. This time we'll have opening inventory, because whatever was the closing, remember the closing was 4,000, is the opening for the month number 2. So we need to calculate that. So it will be opening inventory 180,000. This closing will move to the opening here, so 180. And then we have a production cost. Production cost is same, 675. Month number 2, you're also making 15,000. This time the closing inventory will be a little bit less, because this time we have, before we had a 4,000 closing, so we make another 15. So obviously, like, we need to see how much is the closing for month number 2. So let's have a look. How much is the closing for month number 2? So we have 7,000. So 4,000 we move there and make another 15 and sell only 12. So you have a 7,000. So 7,000, of course, like give us more closing inventory. So 7,000 multiply 45. 7,045 for the absorption. And that will give me 315,000. That's my closing inventory minus the closing inventory. And we find the cost of sales. So we added this one, production cost minus the closing inventory. That will give us cost of sales. That is 540,000. And we have 75 under absorb. And that will give me the profit 705. Under the marginal, we have 450, same production cost. Closing inventory will be 210, same way, 7,000 multiply 30. And that will give us our cost of sales, 360,000. And that will give us no over under absorb. The fixed production overhead remains same, 300,000. Marginal cost have no problem. So 660 will be the profit. So you can see here month number 2, the absorption costing gave us the profit 70,000 and 7,500,000. But the month 2 under the marginal gave me 660,000. So always you can see the profit under the absorption is higher than the marginal. We can quickly have a look the difference, why the difference created. So they said to reconcile. So you can reconcile it quickly. Opening inventory, we can see here the for the reconciliation. We can see absorption costing, month number profit, we had 530,000. Month number 2, it was 705. We just took from the previous period. So change in the closing inventory, that's the trick. So closing inventory, the difference was 15. So under the absorption, it was 45. Under the marginal, it was 30. So you can see the difference is 15, the closing inventory. This is all the reason. So the first one was 4,000 multiply 50. The closing inventory was 4,000. So 4,000 multiply 15, that gives us 60,000. So you have a 60,000 here. If we minus it, we get exactly the profit we have from the marginal costing, that is 470. It will match with the previous calculation. And other one, we have month number 2, that is 7,000. We have a 45,000. So closing inventory, 45,000, the difference. And that gives me 660. That is 3,000 unit multiply 15, 45,000. And that's how we can reconcile how much is the profit for both. Okay, so you can read the statement here. It said the comparison of absorption and marginal costing. That will give you some more understanding, but it's not very difficult anyway. So I think this is the end of our chapter. So this is all we have on chapter number 1. The next chapter we have here, that is forecasting technique. This chapter is one of the chapter. Here we're going to look at the time series analysis, and also you're going to look at the linear regression, and also how to calculate the forecast based on the indexation. Now, this is kind of the topic from the economics, but this is also part of the management accountant. The reason we have to learn it, because as a management accountant, sometimes or most of the times, we have to make a forecast for the future. So when you do the forecast, we need to know how to analyze the data, and we have to analyze some past data in order to make the forecast for the future. For example, if we like to know which month normally the ice cream we sell more during the year. So we can see like during the summertime, let's say June, July, August, the ice cream we sell more compared to the January, February, March during the winter time. So this sort of information is come when you make the analysis. So when you look at the trend, if you look at the analysis for the 1 year, 2 year, or 5 year, 10 year, then you have some sort of idea, and based on that, you can prepare the forecast for the future. For example, like if you like to make a forecast for the housing, you see every 8 to 10 years, the UK market faces the recession and the inflation goes high. And of course, like because of that, if you're looking at the data for last 100 years, and if you look at every 10 to 12 years, the inflation rate always goes high, and the UK house market, the price goes low after 8 to 10 years because of the recession, and the interest rate goes high. So this sort of thing will give you idea like, oh, every 10 years, there is a possibility of the recession. So for that reason, you have to forecast, and to do the forecast, you have to analyze some data. And to analyze, we have to looking at a vast data, and this data we use in a different purpose, but we need to know how is it to work when you calculate the forecasting, and by considering the time series analysis or linear regression or index number. So let's talk about the first one is a time series analysis. Time series analysis, as the word is says, a time series. So it's basically is a series of data. For example, we're looking at the data for the every day for the last 30 days. It could be like every month for the last 12 months, or it could be every year for the last 10 years. So we're looking at a vast majority of the data, and based on that, we make the analysis to take the decision or making a forecast for the future. So the time series analysis is looking at a few things. The first thing, they're looking at the trend. Now the trend basically tell us like what is the trend of the market. As I said, for example, if you're looking at the housing market, if we said like, okay, every 10 years, the housing market goes down, and again it goes up, then it goes down. So basically the trend will tell us, if we look at the trend should be from straight normally, so it shows like this. So basically you can see it's like going up and down, going up and down. Or if you want to see like for 10 years, let's say if we make the year here, so that's the years, and if you say like the trend is like going down and up, and every 10 years down, then up, then down. So you can see here every 10 years the trend is the price goes down. So trend is a line, and this line tell us like, okay, every how many years the the price goes down or up based on that specific product or that specific unit or entity we are looking at. Now, for example, if we're looking at the housing market for the last 100 years, and if we say every 10 years, the trend is like the price goes down after 10 years, and again it goes up. So if we're looking at last like 100 years, then we have an idea what will be the future. Seasonal variation is basically tell us what will be the seasonal impact. For example, as we said, the ice cream can be sell more in the summertime than winter, or maybe the fan or heating will be more used in the winter than summer. So there is some seasonal impact, even though people continuously use some product, but because of the seasonal variation, the demand can goes up. For example, when you're looking at the t-shirt during the summertime, the t-shirt selling can go high because people buying more t-shirt on summer compared to the winter, or in winter the jacket will go high. So this basically the reason of the seasonal variation. The cycling and the random variation is a little bit different. The cycle variation is basically after a certain period. For example, every 10 years, people change the fashion style. Or for example, let's say if one trend is now, for example, everyone wears something that is oversized. Everyone like to wear the oversized t-shirt or oversized jacket, but after 10 years people will come back to the skinny, or maybe they liked something that is fit with their body. So every 10 years there is a cycling variation, or the trend or the style is keep changing. So that give us a cycling variation. The random variation or that is uncertain variation is very hard to predict. For example, because of the COVID, the price of the mask or the demand of the mask or the protected equipment or with the hand gel, the price goes really high. But this is very hard to predict because it doesn't happen every day. So the random variation is very hard to predict, and this is uncertain. So the way we do the time series analysis, the time series analysis equal the trend plus the seasonal variation. So trend and the seasonal variation. Now, if the question asks us to find it out, the seasonal variation, then we can do the trend that is minus the time series. So when we move the seasonal variation this side and this go this side, so the plus become this side plus, and this was the plus, this side is become minus. So we need to know if the question asks something that is not exactly the formula, we know how to play with that. The next one we have here, the linear regression. With the linear regression, you have to remember this formula, a equal a plus bx. Now here looking at the individual variation. So here y is the total cost and a is the fixed cost and b is the variable cost per unit, and x represent the variable. Now the x could be a number of month, number of year, or cost per unit. It could be anything. It depends on the situation. So x is our variable. So where we have to make a forecast based on the one variable, we have to use the linear regression, and we have to use the formula y equal a plus bx. On the other hand, we have an index number. The index number represent the indexation based on the few things. So for example, when we have an index number, we're looking at the RPI, the retail price index. And based on the index we compare, for example, let's say if we say the price for the house now is going up or going down, but we need to have a comparison compared to which year. For example, compared to 2020, the house price is now more, or compared to 2020, house price is now less. So we need a base year. We need a year to where we can compare. So for the indexation, we need also a base period. For example, if we said like the product of 1 unit was £10 in 2010. So compared to 2010, now it is £20, so increased by 100%. But we need a year, or we need a figure where you can compare. Without having the base year, we cannot compare, is it good or bad? But we need to know compared to what, good or bad. So that if we're looking at the current period and we're looking at the base period, that will give us the index figure. And once we have the index number, with the index number, we can compare like, is it good compared to the last few years or bad? What will be the changes? We can make the forecast. Then you have inflation and the deflation. So inflate or deflate is a very common, because it is possible we can looking at the net present value of the forecast. For example, it is possible we want to bring down all the future cost into present cost, and also it is possible we want to take the present cost into future cost. For that reason, we have to know how to make the inflate the cost or how to deflate the cost. All right, let's have a look. The next thing. So we have expected value. And the important thing here is the for this chapter to know how to make the moving average, how to make the seasonal variation, and how to make the linear regression. That's sometimes this is very common, and at least 5 marks question will be in the exam from this chapter. So let's have a look. Time series analysis. The definition is here. It says a time series is a series of figure or value recorded over a period of time. So over a period of time, the previous data or past data we have, we call it time series. Now, a time series analysis may be used if an organization has collected data about the cost and the revenue over an extended period of time. Example of this type of data include output at a factory each day. It could be last month, so every day, how many days, how much was the output? For example, day 1, day 2, day 3. Then total cost per annum for the last 10 years. How much was the total cost for each year for last 10 years? Monthly sales over the last 5 years. How much we make sales every month for last 5 years. So we take a lot of data to analyze. And the component of the time series, we have a trend and we have a seasonal variation. We discuss these things, so you know already what it is. The formula we have discussed as well. The next one, to analyze the data, because the data is so big, we will not be able to analyze all the data in one format. And that's why you use the moving average. Sometimes we make the data a little bit smaller. For example, when we like to check some file, let's say, for example, in one box, we have a thousands of files. So it is not possible to check one by one. So for example, we take number 5, we take number 15, and we take number 20, or we take, for example, number 90. So we check 4 out of 100. So if we find 90% is accurate, then we understand all the file we have here is 90% accurate. So same way, when you do the analysis with the time series, we use the moving average because we cannot put all the data together. So we make the average so that we understand what's happening with the average. So the main method for calculating a trend from a time series is the calculation of a moving average, which is the average of the result of fixed number of period and relates to the midpoint of the overall period. So here we can look at the trend. That's my trend. Now, if you're looking at here, we have a 4-year, year 1, year 2, year 3, and year 4. Now, every year have a 4 quarters. So 1, 2, 3, 4, 1, 2, 3, 4. You can see here, the sales is always going up on quarter number 3. So the quarter number 3, the sales is really high. Again, quarter number 3, the sales is really high. Then quarter number 3, the sales is really high. So normally in the year, the quarter number 3, the sales is going high up to 2003, and 2004 is kind of same. But in quarter number 2 and quarter number 4, you can see the sales is down. That means if it is happening last 4 years, so that when you make a plan for the next year, we understand quarter number 1 and the quarter number 4, the sales will be always less compared to the quarter number 3. So this is basically taking an idea when you do the analysis for our management accounting. So we always make the estimate, we make the forecast for our company before you launch any product, before you calculate how much will be the profit, how much will be the loss. We always need to make the forecast. All right, then we have here the example of the moving average. Is very simple. All you have to do, if we do the central moving average, we can use, like the question will tell us how they want. For example, if you have a look here, it say the sales figure for a business for the first 6 months of the year are follows. So 6 months we have a sales January to June, and it is felt that the sales cycle is a quarterly basis. So you can see it's a quarterly basis. You can see here the first quarter 35, 37, and 34 is almost close. And the second quarter, April to June, is 40, 40 to 13 is almost close. So it's look like every 3 months, the trend is changing. So the price or the sales or the demand is changing every quarter. So second quarter, this is more than first quarter. It's not changing every month. So if this is the case, we can say we can find the average of these 3 months. So if we added this 3 months, we can find the average. So month 1, month 2, month 3, if we divide by 3, that's the average. Then again, we can do the 3 months. So the way we do is very simple. So we do first 3 months, 35, 500, 37, and 34, this 3 months. Then we take this 3 months, then we take this 3 months, and then take this 3 months. So we find the middle, the average. So this is the average, 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 average. So once we have the 4 average from the 6 month, now we can find, is there any seasonal impact? For example, if you're looking at a little bit down, so if you look at, is there any seasonal impact? So you can see here, that is the actual data, and we make the moving average of the trend. That's the average. From the 6 month, we make it 4, divide by 3, 3, 3, and 3. And then we see, is there any seasonal impact? So if the seasonal impact, obviously we can see here on the February, it will be plus 1667. So for the month February, the sales is always goes up by 1667. On March, it will be going down by 2,883. On April, it will go up and up again. So that when you make the plan for our July or to December, I can use the same way the data so I can see what I'm expecting the sales for the next quarter. All right, let's do one question here. We have one activities. So let's do this one. It's quite simple. He says, given below are the production costs for a factory for 6-month period. Complete the table to show 3-month moving average for this period. So 3-month moving. So we want 3 month. So 3, then 3, then 3, then 3. So let's do that. First, I added this 3 divided by 3. So we have 226,504 plus 251,600 plus 238,200 divided by 3. That gives me 23,8768. So 23, we will write in the middle. 23,8768. And we do the next one, that will be next 3. So this 3 and divide by 3, then it will give us 245,800. Then we do next 3. So this 3, that will give us 242,100, and the final 3 divide by 3, 250,300. And this is called 3 moving average. All right, that's not a difficult one. Let's move to the next one. The next one we have here, that is central moving. So we done this thing. Wait. So the next one, we're moving to the seasonal variation. This is very common in the exam for 2 marks. So let's do that. It's activity 2, JB Limited. JB Limited is planning ahead and wishes to forecast the cost of its main ingredients used in the manufacture of product X. Complete the table below by entering the missing figure. Use minus sign for negative figure. Complete the table by entering the missing figure. Use minus sign for the negative. Okay, let's do that. So we can see here is 2016 cost per kg. So Jan, February, and March. In 2016, the first quarter, we have the cost, underlying cost per kg 180, seasonal variation, and seasonally adjusted cost. Seasonally variation, we need to adjust it to find the seasonal variation. So our cost is 180, and after adjustment is 220. So how much is the difference? So 220 minus 180. So my seasonal variation was 40. It is added. Remember that 180 plus 40 is 220. So we need to find the difference. I know it right here. So you need to know, is it plus or minus? You have to find it out that. The next one, you go bottom to up. So we need to see the difference. So 222 minus 12, that will give me 210. So 210 plus 12 is 222. And the last one, 240 minus 18, is quite simple. That will give me 222. So that's my seasonal adjustment. All right, the next one is says, assuming the trend and the seasonal variation continue as in A above, complete the table below to show the projected cost for the first quarter 2017. Use minus sign for the negative. Now we did before 2016. Now they're asking for the first quarter 17. That means you have to increase it. Remember that we have 2016, January, February, March. So in 2016, we have another how many months? April, May, June, July, August, September, October, November, December. 9 months we have from 2016. 16, 9 more months to become December. But they said start from January. That means it's month number 10. So 1 month from 2017. So that is total 10 months. I have to make a forecast after 10 months. So we can see how much is increasing. So the cost in January 2016 was 180. From 180 is become 210, and from 210 is become 240. So we can see every month is increased by 30. That means it will keep increasing every month, 30, 30, 30. So for the 10 month, 30, it will be increased by how much? 300. So here with that March, we have 240. 240 is the base. 240 plus for the next 10 month, every month will be increased by 10. That means another 300 will be increased. So it will be total 540. So I said on January next year, 2017, my cost will be 540. And again, there will be some seasonal variation on January, that is 40 will be plus. So plus 40, and that will give me 580. And on February, it will be 30 more. So 540 plus 30, it will be 570. In February, you have a seasonal variation plus 12. So it will be 585. And 570 plus 30. On March, it will be 600. And on the March, you have a minus 18, the seasonal variation, minus 18. And that will give me 582. That's how we'll do our seasonal variation. This one you need to practice a little bit. It could be difficult, but it's very, very simple if you understand it. All right, let's move to the next one. The next one we have here, time series analysis, and this is quite simple. So let's quite quickly do it. It's say what equal actual cost for a month less seasonal variation. Remember, this called trend. So trend equal to actual cost for a month less seasonal variation. So if I minus the seasonal variation from the actual cost, the difference we have, we called it trend. The impact of the economic cycle known as cycling variation. The impact of the economic cycle known as cycling variation. That's just a definition. All right, we have a linear regression, y plus bx. Let's do one example to understand it better way. Let's do one question. Linear regression cost. Activity 4, linear regression, the cost. It said the linear regression equation for a production cost y for a business. So y is the total cost, as I told you, and b is the fixed cost, and a is the variable cost per unit. So you can have a look. If you forget the formula, you can quickly have a look. The formula, that is a is the fixed cost, b is the variable cost per unit. So it's a plus bx. Yeah, so a will be the fixed cost, b is the variable cost per unit, y is the total cost, x is the number of activity or output. Okay. So let's do that. So we have A is the fixed cost, 63, B is the variable cost per unit, and X is the number of units. So let's find it out. How much is the number of unit we have? So 63,000 plus 3.20 multiply for 44,000 unit. 44,000 unit. And that will give me total 203. 800. That's it. That's not the difficult one. Let's do the next one. The next one is says here linear regression cells. The linear regression equation for the trend of cells in thousands of units based upon time series analysis of the monthly sales, monthly figure for the last 2 years. Okay. last 2 years. So you need to be very careful when you read the question. Y is the total, A is the fixed cost 4.8 plus B is the variable cost per unit, X is the number. So X is our problem. Calculate the estimated sales trend for each of the first 3 months of the next year. Okay, next year. So that means we are in first year and they're looking at the next year. So they're asking to find the monthly figure for the next 2 years. Remember that 2 years means 24 months. 2 years means 24 months because X represent each month. X represent 1 month each month. That means for the 2 years, we have 24 months. All right, so X equal to 24 here. So let's do that. So first one, after 2 years, the first 3 months. So figure for the last 2 years, we need to calculate. Calculate estimated sales for this first 3 months of the next years. So we have already 24X. That means we have up to December. So if I go January, that's month number 1, first 3 months of the next year. So that will be January, February, and March. And here, the X will be 25, 26, and 27. Because each month represent X. So for 2 years is 24. So that means any next year or any future year, it will be more X. So we said X equal to 25. So we will have 4 point, so Y equal 4.8 plus 1.2. The multiply will be 25, the first one. And the next one will be Y equal 4.8 plus 1.2 multiply 26. And the final one, 4.8 and 1.2, 27. And that's it. So first one will be 34,800, and then 36,000, and 37,200. That's it. So X is basically the independent variable. All right, the next one is says activity 6. Let's quickly do that as well. A company's selling and distribution costs vary in a linear manner and can be expressed using the regression using Y equal BX, where X is the number of units sold. Okay, that's not a problem. But we need a variable cost and we need a fixed cost. The question didn't tell us anything. So the total delivery cost 400 unit and 4,000 unit. 10,000 is for 400 and 28,000 for 4,000. That means we need to find it out by using the high-low method, because they didn't tell us how much is the variable cost, how much is the fixed cost. So let's do it. 4,000, the cost is 28,000, and the 400, the cost is 10,000. So here we have 3,600 unit, and here we have 18,000, the cost. This 3,600 will go under the 18. That will give us variable cost per unit, and that is 5. Variable cost per unit. Now we need to find out the fixed cost. We can take any of this, take 4,000. So 4,000, the total cost 28,000. If I take out all the variable costs, so 4,000 multiply the variable cost 5 per unit. So that will give us 20,000. And if I take out the variable cost remaining, we have 8,000. That is fixed cost. Now I can use it. So the value of the A is a fixed cost, that is 8,000. And the B is 5, variable cost per unit. All right, the next one we have here, that is the indexation number. And as we said, the index is basically the measurement over the time of the average changes in the value, price, and the quantity of a group of items. Now the characteristics of the index, we have a base period, we have to compare a period, so we need to know for which period, against which period we are comparing. The basket, inside of the basket, what we have, that is RPI, retail price index. For example, we can have all the product to find a average. So normally the base period is 100, always set to 100. The basket shows all these things. For example, RPI represent food, clothing, heating, restaurant. Now it is not necessary every time it will be relevant to that organization, but obviously like RPI represent everything. For example, even the beans, even the fruits, everything together, they represent the RPI. It's like average, increasing, decreasing of the inflation. For example, when you see the inflation is increasing, that means RPI is increasing. Then we have a weighting. Weighting represent like which one have more value compared to others. And we have index number. This show the general movement of the data over a period of time and may be used to inflate cost future period or maybe deflate cost to the previous period. So sometimes we can make the present cost to future or future cost to present. Then we have a calculate the index number. How we calculate the index number? Current period always in the top, remember that, and the base period always in the bottom, multiply by 100. 100 is the set of the base. And that will tell us what is the index number. Okay, let's have a look on example. So you can see here, we have a calculate the index number. The sales figure for a business for the first 6 months of the year as follows. So we have a January, February, March, April, May, June. And the index number, the base period is always 100, remember that. Now we need to see how is it increasing or decreasing. So you can see here, so first one is we are comparing with the January. We'll set January as the base period. So January, we're comparing January with February, with March, with April, with May and June. So January is my base. So I'm comparing, like compared to my January, is the price is more in February, more in March, how much increase in April, how much May. So you can say like, okay, from January, the price increase in May, this, April, this. So I'm comparing everything with the January. That's why 136 is my base, and that's why 136 is always in the bottom. The base period always in the bottom. And the 100 represent the multiplication. So that shows the percentage basically. So we can see the current period always in the top. That's the current period, 148, then 140, 130, 138, and 145. So you can see here in January, our index number is 109. Then in March is reduced. So we can see here 140. So is basically in February actually. So current period is 136 compared with the February. So it is 109. The index number for the March is 103. Then index number for April 96. Then is increasing from 96. It is going up to 101 and 107. So you can see here from the index number we can determine that there is a general trend upward in the data. So it's basically after the April is going up from April from 96 and 101 and 107. So it could be up or down, it depends, but that's how we're going to calculate the index number. So let's have a look, some more thing. So you have one question, let's try this one. So we have here the cost per kg for the material used in the production has been as follow for the last 4 months. So for the last 4 months, we have this story. In January, we have a 26.20, February 26.8, and 26 and 25. So in April is going down. All right, from January February is increasing, March also increasing, and April is going down, okay? You can convert the cost per kg for January to April into index number using the January 2007 as a base period. So we're going to use January 7 as a base period, and in January 7 it was 24.95. So we'll compare based on the last year, because we are now 2008. So compared to the January 7 2017, how much price is increasing in January 18 and February, March, and April. So that will be our comparison. So in January, we can see here 26.20, and then 26.8, 26.90, and 25.80. So we need to use our index number. So the base period will be always under, that is 24.9, and the current period will be top. The current period is 26.20, January 2018, and divide by the base period 24.95, and we need to multiply with 100, and that will give us 105.01. They said 2 decimal. Again, the index number, the current period will be top, 26.80, divided by the base period 24.95, and multiply with 100, and that will give us 107.41. Again, the current period in the top, 26.90, divide 24.95, multiply 100, and that will give us 107.82, and 25.80 divide 24.95, and that at 103.41. So you can see here, after the January, on February, March is increasing, and then again on the April is going down. The same way in April it was going down. All right, so let's have a look. Then we have somehow to make the present value to future value and future value to present value. Is not very difficult, it's quite simple. And then we have a activity 8. Let's quickly do that. So T's are limited makes and pack tea bag. The information below relates the price of a tea, okay, related to the following cost at January 2017 price. Give your answer to 2 decimal, okay. So you have 2017 January actual cost, index number, cost at January price. That means we bring all the costs at January price. So February will come back to January price, March will come back to January, April will come back to January, May will come back to January, June will come back to January. So basically we are making the future value into current value. So how we do that? So we do our actual cost 4.95, then divide with so we do divide with 103, that's my index, and 103 is my base. So we say 103, and we divide with 103. The first one will be same because I'm in January, so my cost will be same in January. So that will give me 4.95, because the price in January will be same like January, because the value of £1 today is exactly £1, so it will give us the same value. But if you look at the February, it was 4.97. So if I bring it back to the January price, how much it will be? So it will be 103, the base, and it will divide by 105, the index number, 105, multiply by 4.97. And that is give me 4.88. That means what is in February, the price is 4.97. This is equivalent to January 4.88, because remember the value of the money is always goes down, and for that reason whatever is cost today, in future the value is always going down of the money, and that's why like you can always deflate or inflate the money. So today's £100 maybe after 1 year is equal to £110. Then the next one we have, again we have 103 is on the top, divide 106. Remember that current period will be under if I want to devalue. Multiply 4.99, and that will give me 4.85. So you can see the price is basically making it down. So whatever the price will be March 499, in today's price it is equal to 485, and that's how we can do all of this thing. So 103 divide 107, multiply 5.05, and that will give us 4.86, and the next one will be 4.80 and 4.73. So you can see here in June the price will be per kilo 510, but in January it is equivalent to 4.73. The next one is, say these are you are now forecasting price of the tea July to December for the future. Now you see the price will go up. Restate the June 2017 price at the future value. So whatever we done June 4.73, I want to make a future value. I want to see how much will be the cost in the future. Because this is June 510, I bring it down for January. Now I want to bring it down for the next year's July. So we do opposite. So 510, this time 5 and 10. I'll put the current period in the top this time. So multiply current period will be in the top, and the base period will be under. That is 111. This is the base period now. I'm following from here, comparing from here. And that will give me the cost 5.28. You see it will be going up now. So whatever is we have last year June, and if I compare with the next year July, it will give me the price of 5.25. The next one we have August. Again, we take 5.10. Because I'm in June and I want to see the future price. Multiply with 116 divided by 111. That will give me 5.33. Then again 5.10, multiply 119 divide 111, the June price. That will give me 5.47. And the next one will be 5.51, then 5.61, then 5.65. So you can see it's going up. So if I am sitting down in June and if I'm looking at the future price based on this is my base period, then you can see it will going up for the next period, and that is always happen. It will always go up in the future. So this is not very common in the exam, but you need to make sure you still practice, because you never know, it could be coming in the exam. The next one is says like limitation of the index. So make sure you read that, because it is very common in the exam. They'll ask you some theoretical question or multiple choice question or true and false question. For example, the index number put together all the price index, but sometimes it is not relevant to the organization. For example, if we have a tea factory, maybe the clothing is not important for us for the RPI. So sometimes it is not very relevant to me. That's the limitation. Limitation represents the disadvantage. So you need to make sure you read that. All right. So then we have the next thing. We have the one question, activity 9. That's for the seasonal variation. Quickly have a look. It says you are employed as an accounting technician, YSP Game Limited, which manufacture a range of video game. You attempt to forecast the sales demand for the July to December. So we can see here the July to December. So we can easily see in July we have a trend is increasing from July to August, then August to September is increasing 5, 5, 45 to 50, 55 to 55, 60, 65, and 70. So increasing by 5 every month. And the seasonal variation in September is a plus 150, 175, 170, 350. So you can see in the December, the games is increasing more, 350 seasonal variation plus. That means during the Christmas time, people buy the games a lot and they play a lot because maybe it's a holiday time. And June, July, July, August is very low. So explain the term trend, seasonal variation, we explain that. So we can say like in July and August, the seasonal impact is 0 because people don't buy in the summertime. But during the holiday time, Christmas time, people buy games a lot. And that's why the sales goes really up. Yeah, I think that's it. You can say that. What is there? It says limitation. Limitation could be like always disadvantage. You can say like it is possible like people don't follow the same trend anymore. Maybe they don't buy this game anymore. Maybe they buy something that is cloud-based. Maybe they want to play something new. So obviously it's not what is happening right now. It will be always happen in the future. So you have to explain the disadvantage, because what I am looking at the data last year, last 20 years, not necessary. It will be always forever, because new market can come, competition can come, and there could be a different impact on the seasonal variation. All right, then you have a sensitive analysis. This is a little bit important, so make sure you read that as well. So we have a sensitivity analysis means how sensitive this information to take a decision. For example, if you sell coffee or tea, and if you stop selling the milk, what will be the impact on your sales? For example, if you sell tea and coffee, and if you stop selling the tea, and if you sell only coffee, what will be the impact on your organization? How much sales will go down? Or for example, if your labor cost is very high, skill labor, let's say that the job you do, only few people can do it, not everyone. So what happens if the person leave the company, or if there is something happen there, or if the labor cost going up? So sometimes you are making a profit, let's say like very much on the threshold. Let's say your cost is 10,000 and your sales is 12. So that means you're making only profit 2,000. So if any cost going up, then you will not make profit anymore. So that shows the sensitivity analysis. So you can see here, they said the sales is 2,000 unit, 4,000 material, total 3,000 contribution, 1,000, and fixed cost 800, and the profit 200. Now, if the profit is going down by 200 only for any reason, for example, if the sales reduced by 200, or if the cost increased by 200, then this 200 will be gone. It will be 0. So there is no more profit. So for any reason, if the cost or sales going down by 200, the company don't make any profit anymore. Top of that, the sales volume 20% sensitivity. So if the sales volume going down by 20%, then you will make a loss. If the fixed cost increase by 25%, you will make a loss. Material, if it is 10% increase the cost, then you will make a loss. Labor increase by 20%, then you make a loss. And selling price is increased by 5%, decrease by 5%, then you make a loss. That means now you are selling 2,000 unit for 4,000. So if it is decreased by 5% only, if you need to reduce the sales only 5% because of the market competition, or for any reason, if you want to reduce the selling price by 5%, then the company will not make any profit anymore. The company will make a loss. And for example, labor cost, material cost. If the material cost increased by 10%, now the material cost 2,000. If it's increased by 10%, it will be 2,200. That means you will make a loss, no more profit. So these two, 5% and the 10%, is the more sensitive, because little changes will make your company from profit to loss. So that's how we're looking at how sensitive this information is in order to take a decision. All right, so I think this is the end of our chapter number 2. Actually, make sure you revise like again, and obviously like more you revise, you will feel more confident.